What's going on, everybody? Welcome back to another video. So in this one, first, I just want to say hopefully you guys are having an awesome long weekend here. I know you guys did absolutely amazing over this last week with the volatility. Hopefully you're able to enjoy yourselves. But in this one, we're going to be going over a very significant crisis that is forming in the overall market that nobody is talking about right now. And it's something that you guys need to be aware of, especially going into not only the September Fed meeting, but towards the end of the year as well, because people are focused on one thing when they really should be looking at something else to look at and kind of determine where price is going to move in terms of overall expectations going into the future. So again, guys, if you do enjoy these types of videos, the information and analysis that I do provide you guys, all I ask, go down and hit that like button. It helps get this information out to as many people who want to learn. And if you guys do want to see more videos like this, make sure you hit that subscribe button as well and drop a comment down below of what your favorite trade was over this past week. So let's get right into it here and pull up the chart of the SPY on this daily time frame here. So 1348 is going to paint the perfect picture for us. It's the most profitable EMA crossover and why it's on our charts all of the time. Now, looking at this here, we did just get this daily cross down. Now, typically when we see these cross downs on the daily, we are going to see a little bit of a continued move. But looking at what we're seeing on the different support and resistance lines right here, we are slipping down below this key support level here, and we also have this pretty significant gap right at 389. Remember, a couple of days ago, we were talking about the market, and if it slipped to that 393 level initially, it was going to come down to 390, then bounce right back up, and that's exactly what we saw, and now we are coming back down, approaching that 390 level here as well. And when we look at what happened with the market on Friday, this is one of the most interesting moves that I've seen in a while, and there's a very specific reason as to why. You saw some of the jobs numbers, unemployment data start to come out, which is what a lot of people are focusing in on right now, which they don't necessarily need to be. We saw a little bit of relief coming up to that 40160 level, and then a nasty cross down, and everybody started to print. Again, guys, our Invictus algorithm called this out at 12:22 p.m. It's a predictive algorithm on the 5-minute time frame. So if you guys are interested in kind of getting access to this, it's one of the most powerful tools that retail investors have on the market right now, combined with Pythagoras and Trader Joe. If you guys are interested in that, we have an awesome community of people that are actually taking control of their own portfolios and empowering themselves to make money in this marketplace, because all of us have these long positions here and we need to be able to hedge to the downside and make money short term. So link down below if you guys are interested, but let's get right back into it here and kind of take a look at exactly what the data was. Now, we've been breaking this down a lot. Non-farm payrolls right here came in a little bit lower than expected, meaning that the growth in the addition to people to the workforce, excluding basically agriculture, was a little bit lower than what the market was actually pricing for. The unemployment rate went up and the average hourly earnings of those employed went down. So remember what we were talking about a couple of days ago with the overall job market and what the Fed needs to see. If we start to see a hot job market where there's got a lot of jobs getting added back to the market, well, we're most likely going to see the Fed be even more aggressive. But if we start to see kind of a softening labor market here, we could see the Fed start to back off. But there's a wild card here and a crisis that people just aren't really focused in on, and it's leading to a couple of pretty big mispricings in the overall market here. And we can see that in this Fed Watch tool right here. Well, yes, we did see these job numbers over this last week start to get a little bit softer. Now, you can look at this from a variety of different lenses, but there's really mainly two. You can look at it as kind of the financial stability of the everyday American, or kind of the overall macroeconomic environment. The data that came out for everyday Americans, not great. The data for what the Fed can potentially do in terms of its policy going forward, it might give them a little bit of wiggle room to be a little bit less hawkish here. But what we're seeing is a 57% chance now that they're going to be doing a 75 basis point hike in September. Well, remember, a couple of days ago, that was at 75%. So the market, for some reason now, after the jobs data, is pricing in lower rate hikes. But what this shows us here, that it's basically 50-50 here, is uncertainty. They are uncertain as to whether or not a 50 basis point hike or a 75 basis point hike is going to happen, and that's going to lead to more volatility. If you were to see the 75 basis point range, this target rate of 300 to 325 basis points, shoot up to like 95, well, then that would mean that the 75 basis point hike is already priced in and the market already expects it. Right now, well, the market doesn't really expect it yet. So there could still be more pricing in, and we could start to see the market come down. And going back to this chart here, throwing this back on the daily time frame, in looking at kind of where we could see the market go, we could end up seeing the SPY end up touching that 380 level, depending on what the data next week comes out at. But I'll update you guys on everything about that coming out as it does. But kind of going off of what we were talking about just now with that jobs data and kind of going into what we were talking about with the Fed, they have been talking about, especially since Jackson Hole here, that they do need to really come out and get inflation under control. You can see right here, pain management, not pain avoidance. And that's pain for essentially the overall economy. The Fed is walking a very fine line right now with pushing us too far deep into a recession or not doing enough in letting inflation run out of control. But this is where the massive crisis comes in that you guys need to be aware of, and it's oil. When we come over to this article right here, we're seeing this start to happen in the UK right now with no end to the Ukraine war in sight and transition away from Russian gas ongoing. Scale of support will have to be massive. You are seeing a very, very significant energy crisis in Europe right now, and we are going to see it start to affect the United States as well. Now, something that you guys may not realize about oil is it affects a lot more things than you may not realize. Electricity. If you have to transport food, what are you going to transport the food by? Well, trucks, and you're going to need oil for this. A lot of things are affected by oil. So the bond markets and the oil markets are incredibly important right now. Now, yesterday, when we did start to see the market here, let's throw this back on the 5-minute, start to trend up here to that previous level of resistance, this 401.50 level, we ended up starting to get more oil news, and this move was very, very aggressive. When we come over to this piece right here from Goldman Sachs, today G7 ministers announced that they were moving ahead with implementing a price cap on Russian oil by December 5th, with the specific goal of avoiding losses of Russian oil supply next year. Again, if the supply decreases and the demand goes up, you're going to see higher oil prices just based off the normal supply and demand metrics. Conceptually, such a price cap, if fully and successfully implemented, will allow Russian oil to flow while simultaneously achieving Europe's aims of limiting Russian oil export revenues. At present, the price cap is addition to the EU embargo rather than substituting for the ban. And you can see the title here, Russian price cap. They're talking about oil prices here, bearish in theory, bullish in practice. The key risk to this policy, however, is the potential for Russian retaliation, which would turn this into an additional bullish shock for the oil market. Consistent with actions taken in the natural gas market, Russia could opt to retaliate, cutting G7 buyers off and shutting in production, thereby elevating global prices and its own revenues, even assuming higher logistical costs to non-participating countries. So what we're seeing here is a very, very interesting time going into the end of the year where everybody kind of realizes, but not fully yet, that as the weather starts to get colder across the globe, the demand for oil is going to go up. When we come over here and take a look at essentially how much oil prices are actually affecting inflation or the consumer price index, the CPI, it is very, very significant. Now, right here, gasoline prices are so much more volatile than other CPI components that even though gasoline makes up less than 6% of the CPI, it is often the main source of monthly price movements in all items of the index. So if you start to see oil go up, it's going to affect not only the oil component of CPI, but like we were saying before, a lot of the other components of the consumer price index, and you are going to see inflation persist. So kind of wrapping this up here, we did see the labor market start to soften a little bit, but the Fed is also going to be looking at what is going to happen with the oil market because that is going to be driving inflationary pressures in not only the economy, but the worldwide economy as well. So guys, that is kind of going to wrap up this video here. If you did enjoy the information and analysis that I provided for you guys in this video, make sure you go down and hit that like button. Again, it costs you nothing to do it, but it really helps us out a whole lot in getting this information out to as many people who want to learn. And if you guys do want to see more videos like this, make sure you hit that subscribe button and turn on that notification bell so you're notified every time I post a new video. So I hope you guys are having a great long weekend. I'll see you in the next one. Peace.